This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. We're back. We're back with a new podcast. We had a few weeks off there, but we are back just in time for a look at what worked here in 2024 off of the value stocks we've talked about and, some of the areas and industries we've talked about. What is it looking like as we go into 2025? So I've been saying that this has been a good year for value investors in general, but here in December, we've given back a little bit of the goodness, the good gains that we had on some areas, stocks in some of the areas, especially I would say on the home builder side. Those had been up quite considerably on the year. But now the street is getting a little nervous about what might happen with the home builders for next year, and that maybe earnings aren't going to be quite as strong, and those margins are not going to hold up near these record levels that they've been at the last 2 years. Now, if you remember in housing, the sales are way down still. They're still down 30 to 40% for the new home sales off of the 2021 highs. And then the Fed raised rates starting in 2022. It froze the market in 2022. The buyers basically sat on the sidelines once it went up to 7%. But the home builders were able to come up with a basket of incentives, including buying down the rate. And some of the buyers got a little more comfortable with it at those levels. Now we've been basically between 6% and 8% on the mortgage rates for the 30-year fixed since then. And you have seen the buyers adjust to those rates. So sales, though, have not really come back in the big way that we had in 2021. So the sales still remain mostly depressed. Inventory had fallen to record lows starting in 2022, but that has changed as well. In some markets, we're back to 2019, and that is for the existing homes. And why that matters for the home builders is that if you can't buy an existing home because there's not enough on the market, you will switch over to the new home sales. Historically, new home sales have been about 5% of all home sales, but in this cycle, they did jump up to about 20%. And that's key for the home builders because that gives them pricing power. They don't have to give out as much incentives other than maybe on a rate buy down, which is expensive for them, but they don't have to give you, that appliance package or those countertops and spend money on that to lure you into to buy the home because there really is nothing else for you to buy in some markets. But again, that has now changed. We're over 2 years into this cycle. The Fed is cutting, but those mortgage rates have not really come down. In fact, they've kind of gone the other way, back up over 7%. And now the Fed is saying that they may only cut twice more next year. And so the 10-year is, not really looking good for home buyers. But that being said, the buyers have adjusted to these higher rates. And in markets where there's still some affordability, which is areas like the Midwest, parts of the Southeast, some parts of the West, but the more rural areas, then, you can still find buyers buying. It's just a matter of it being an affordability issue with those mortgage rates over 7% on mostly the hot cities and the hot coasts. But again, we've seen inventory rising now in certain cities, and that could bring the prices down both for existing homes, but that's also going to give, bargaining power on the new home sales. So we'll see how that plays out. It is a big value industry here in 2024. And now the stocks have come down off their highs. And we've talked about home builders all year because they have been in our screens. They've had the really great earnings and they've had the high Zacks ranks. So they've they've come up in all the screens with those low PEs and even PEG ratios. But now, again, things might be changing a bit depending on which home builder you are, what type of market you're building in, and what part of the country even that you're in. These are all going to become factors in 2025. So is this still a place to be? Let's take a look at one of the stocks that has already just recently reported earnings. We are going to get a bunch of them reporting in here at the end of the year, starting in January again. So I'm not going to talk about those because we're still going to get more in. But Toll Brothers, ticker TOL, we've talked about it in the past. It has already reported, as I mentioned. I own it in the value investor portfolio and in my own personal portfolio. And it beat again when it just reported here in December of 2024, but it guided a little bit light for the next quarter on its gross margins. So by a little light, that means instead of doing like 27.7 on the gross margin, they're going to do 26.25. It was in the 26 range. For the full year, they were still guiding 27 or a little bit above that. But this next quarter, a little bit lighter. It did spook the market, and the shares are down over 10% on that news. But let's look at it. It's now a Zacks number 3 because those estimates were being adjusted, and they're kind of all over the place for this fiscal year 2025. One is higher in the last week, 2 are lower. So the analysts are kind of figuring out now that they've reported where they should be. Same kind of for next year, next fiscal year. 2 are higher, 1 is lower in the last week, but the estimates are actually a little bit higher there. So for this fiscal year, the analysts do have an earnings decline of 3.9% still. And then next year, rebounding with 11.3. Now, everybody was thinking the Fed is cutting, those rates are going to come down. 2025 could be a great year for home builders. The sales would pick up, and so would earnings. Basically, if they're going to sell more at these elevated prices, then earnings would look better. But now the market is thinking that may not happen. So the shares have come down. It's trading with a PE of 9.2. It has a PEG ratio of 1. So that's right on the cusp of being both a growth and a value. And price to sales, 1.2. Price to book, 1.7. So those are all real low. So this is still a value stock. But when you're looking at those earnings, and they are expected to decline this year, and they're only in the first half of this fiscal year, then you might say this sounds a little bit trappy. And that may be, but with the shares now declining further, and if these mortgage rates go up higher, I would expect the home builder stocks to go lower. Then I would be looking to add to my position or get into a new position on a correction, which is 10% down, which is what we already have. Or if we get a bear market in these, then that's a real buying opportunity at 20% off, because the demand is still there. The millennials are still the largest generation, and they still want to buy those homes. So right now we are dealing with still pretty tight inventory in most cities, and we still have the demand if those mortgage rates would only just come down a little bit more. So I still like all of the home builders, and Toll Brothers, it's a luxury home builder. They said that 28% of their buyers were paying all cash still in this last quarter, and they are still, those who are taking out a mortgage, it's still putting down more than 20% down, almost a little over 30% they were putting down on average. Of course, these are the luxury homes that are $1 million or more for the most part on average. And so this buyer has, stock portfolio, which is hitting new highs. And so they have a little more firepower than some of the others. So I await to see what's happening on some of the others we've talked about this year. They would be like Lennar, Pulte, DR Horton, KB Home. We've talked about all of these. And so I'm kind of waiting to see how that first-time buyer who's looking at a lower price point is handling it and what they're seeing going into this next year. Now, when the rates did come down in the fall, kind of suddenly, when the Fed started cutting, then they did see a rush to the sales centers and online shopping. But when those rates went back up, things cooled off again. So now they're back up. I'm expecting them to be pretty cool, but this is kind of the off season. The spring buying season starts in a couple of weeks, but it does start mostly in January now. So we'll wait and see kind of what happens and what these companies are seeing as they report their earnings. So tune in to my either my Blue Sky, my Twitter, my Stock Twits accounts. I'm going to be tweeting out about their earnings. I'm going to listen in on some of these conference calls. I listened to Toll's conference call, and it is what you would expect, like regionally is happening. They are seeing some slowdowns in some of the markets in Texas and in some of the markets in Florida. Jacksonville was holding up the best in Florida for them. And then they saw softness in San Antonio, but they did say Houston and Dallas were, quote, back, unquote. So they were weak previously, but it seems like there's been a surge there. And then Austin, we know, is pretty weak and has a lot of inventory. So that's going to be one of the markets to watch. But home builders, it's going to be interesting. They were, big performers until just a couple of weeks ago here in 2024. And there could be some bargains in 2025, but it doesn't look to be a smooth sailing in 2025. So it could get a little rough. You better have a strong stomach to be in the home builders for next year. So that is Toll Brothers, ticker TOL. Now, staying in the same area, because I'm talking about it, we talked about Mr. Cooper's Group on the podcast. Mr. Cooper Group, I guess that's what it's called, Mr. Cooper Group. It's on the mortgage side. So that's where you're getting the financing, right? And the reason it seemed so interesting was because everybody thought with the Fed cutting, those mortgage rates would come down and mortgage demand would pick up for 2025, including refis. So anyone who got like an 8% mortgage, once it goes down to 6%, you're going to refi that. And that's business for Mr. Cooper Group. Now, it's still a Zacks number 2 rank. It still has an A-style score for value. And it's still trading cheaply at 9.7 on the PE. Price to book is 1.4. Price to sales is heavier or higher on this one at 3.2. So far, the analysts don't seem real concerned that the mortgage rates haven't come down. They still expect 39% earnings growth for this year and another 31% for next year. So that's pretty bullish there with a 25% gain in revenue for next year. Some of that is because, they are expanding with the mortgages. So, that's where they're getting a lot of that revenue growth. But still, you'd think there'd be some nervousness here if there's nervousness in the home builder side. But so far, no. These shares are down off of their recent high, but not a lot. I would say like 5% off. But we'll see if this can hold up as the new year starts. But it's still dirt cheap. I own it in the value investor portfolio now because I did like the numbers so much when I talked about it here on the podcast. And I also own it in my own personal portfolio because I still believe that that demand is going to pick up on the mortgages, and certainly for those refis. Eventually, we will see that. And so it's cheap enough. If, it was trading at 20 times earnings, I would have more hesitation, but it's trading under 10 times still. So, nobody's pricing in some big windfall for next year necessarily on this one. So that's Mr. Cooper Group, which we've talked about and has been a big winner so far in 2024. It was trading near its highs recently, but it's pulled back, like I said, maybe about 5% off those highs. So pulls back some more, it will be very attractive with these valuations as well. So that's Mr. Cooper Group, COOP. Okay, switching to some other industries. So we've talked about infrastructure, and over the years, we've talked about some of the rental equipment companies. And I did want to check back in with one of those, and the big kahuna, United Rentals, ticker URI. It's a Zacks number 3 right now. It's got a B for value. So it's just basically a hold. It's been soaring over the last couple of years. I think I saw it on some of the lists of the best performing S&P 500 stock. It wasn't in the 5-year, but I want to say it was either the 10 or the 15-year. And it's pulled back off of its recent highs as well. And so I kind of keep this one on my watch list because I've been in and out of it over the years in the value investor portfolio. And then we would get like stopped out when, COVID hit or something. And then, 2022 happened and everything sold off, and then we couldn't stay in it then either. But on another pullback, I still love this business. Infrastructure spending is still going to be going on through 2026 with the Biden infrastructure plan. That money is still making its way through. There's other areas of the economy that are big in growth on the infrastructure side outside of the government, including the data centers. A lot of data centers being built. We're probably going to see a lot of spending on the energy side, both oil, natural gas, but nuclear, various things on the energy, the grid, just everything with energy. So this is an area I still see some good things. And now on this pullback, which is about 11% in the last month, that's that's a correction right there. It's still higher, up 29% year to date, but now has pulled back about 11%. If it continues to pull back, I'm going to continue to be even more interested if I can get this even cheaper, because it did get a little bit more pricey for me. Growth isn't that good. It's good, but not that good. So currently it's trading with a forward P of 17.5. It was trading around 20 times before this recent pullback though. Price to book is higher, 5.8. Price to sales is 3.3. And then the PEG ratio is 1.8. So it carries a lot of debt. Every time I buy it, I get some emails from all of you saying, but Tracey, it has all this debt. And it has debt because they are equipment rental. They have to go buy the equipment to rent it out. So that's a heavy cash business, where they have to take the loans to get the equipment. So it's always going to have a lot of debt, a lot like energy companies. They have to, invest to build in the rigs to drill. So they got to build that refinery. And so they take on debt to do these things. So this one has a bit more debt than some of you might be used to. 2024, the earnings are expected to be up 6.7%, and 2025, 7.5%. That's what I mean about like slow growth. And so I got to get it cheaper. And even 7.5, it's looking more attractive, but I'd rather get it around 14 or 15 times. So if we get an actual bear market on this one, it's going to get down there. And so that will make it much more attractive. But right now, analysts aren't really doing much with the earnings. They reported a while ago. There are 9 lower for both this year and then 8 lower for next year. So they clearly, didn't give quite as good a guidance. And so everybody had to cut and get a little less bullish on this one. But Otherwise, the story is pretty much still intact, and they continue to grow by acquisition and acquiring a lot of smaller players in their industry. And so I've always loved United Rentals. We've talked about it off and on over the years. Ticker is URI. Be on the lookout. If it falls further here, it will be even more attractive. Okay, kind of keeping on that infrastructure energy side of things, we talked about Powell Industries a couple of months ago here on the podcast, and this is the first time I'd ever heard of it, and it was crushing it. It was cheap, and there was no reason why I didn't want to buy it. And so I did. I bought it for the value investor portfolio, and it's continued to perform well, but it too has pulled back off of kind of these red hot highs because it is involved in basically the energy infrastructure and build out. And so everybody's assuming we are going to need to do more on that angle as these data centers come online. They use an enormous amount of energy that is for AI mostly. And so business is gonna look good for a company like this, everyone believes, for the next several years. We only have two estimates on it. One is higher in the last 30 days for this fiscal year and next fiscal year. So the analysts haven't gotten bearish on next fiscal year at all. They see 11.5% earnings growth for this fiscal year and 8% for next fiscal year. That's pretty good. PE, though, has become a little more stretched, even though the shares have come down a bit off of their recent all-time highs, but still at 17. That's not nosebleed levels by any means, but with that, kind of growth on the earnings side, I wouldn't expect it to be 30 times. I wouldn't want to pay that, but I would like to get this one a bit cheaper as well. PEG ratio is 1.2, so not bad on the PEG. Price to book, a little bit elevated at 6. Price to sales at 2.9. So it's not as cheap as it used to be when we talked about it a couple of months ago. But again, if those shares come down a little bit more, then I'm really interested. So over the last month, down 15%. It was hitting new highs and was really red hot there. For the year, it's still up 167%. So you can see how crazed it kind of got in this stock as the year went on. So it's just getting a little bit of air out of it. But again, the valuations are still really attractive. If it was trading at 30 times and I had just talked about that kind of earnings outlook, then I might say, this seems kind of pricey for what I'm getting. But it's not. It's trading at 17 times and it's coming down off of those new highs. So I'm liking it. Again, if it goes a little bit cheaper here into the new year, then us value investors should be adding to that position. So that's Powell Industries, ticker POWL, and they're down in, I believe, Houston, Texas. Okay, then we're going to wrap it up with a retailer. Now, over the years, various retailers have shown up on the screen off and on. I've talked about the same ones, and I'd be like, yes, it's this company again. Yes, things don't look all that great. We've looked at this particular company for, is it a value or is it a trap? And it is The Gap, ticker GAP. Over all the years I've done this podcast, we've talked about like various turnarounds. Then they were going to spin off Old Navy and couple of the other brands, and then they were going to have, standalone CEOs, and each of those after they spun it off. Then they decided not to do the spin-off. Then they got rid of some CEOs of individual brands in there. Then they have tried to do a turnaround of Banana Republic, taking it higher up, elevating that brand into a more luxury brand. We're kind of in the middle of that. Then Athleta had a hiccup, and that stumbled, and same-store sales for Athleta really tumbled, but that seems to be turning around. So Gap is a turnaround play as we end 2024. I still like it. It's still cheap. Year to date, let's see, it's now only up 16.7% year to date. Over the last month, it's still up 13.4%. It is looking to have a very nice holiday season, and that has been huge for all the retailers. Nobody is talking about a recession on the retail side for the holidays. Whatever else happens in 2025, we'll see. But holidays, they're big time. This is the vast majority of their revenue, and they're all pretty seemingly optimistic, including the Gap. So the stock is doing fairly well and holding up in some of the selling pressure we're seeing here in December. It's a Zacks number 1 rank still. It is an A for value. The PE is at 12.3, so that's still cheap. Price to book, 2.99. That's right at my cutoff. I look at 3 and under, so it would qualify at 2.99. Price to sales, just 0.6. So I'm liking all that. But you have to know and believe in this turnaround. Are they really doing it? Are they really able to turn it around here? Or can you get this cheaper? So the analysts are pretty bullish on the turnaround for this fiscal year, at least, and that includes this holiday season. This fiscal year does end at the end of January. So that is 7 estimates are higher for this year, but they're also 7 higher for next year. Earnings expected to be up 41% this fiscal year to $2.02 from $1.43 last year. That's a good thing to see because, as we know from just talking about the Gap all these years, this stock has really struggled to go in the right direction. Every turnaround has not really produced an actual turnaround. This one seems to be, but we really won't know until next year and see if the consumer holds up and if they stay on trend and the consumer is buying into what they're doing at all of their brands. For now they are, but the consumer is so fickle, as we know. But this one expected to be up 6.6% on earnings for next year to $2.16 from $2.02. 7 estimates are higher as well for next year, but we won't really know until after the holiday season, and then we get another earnings report in a couple of months from the Gap, so that we can kind of see what's happening in 2025. But the U.S. economy is holding up fairly well. The Fed is still cutting, even though they may do less cuts next year. That is a result of the economy doing a little bit better than everybody expected. So they don't have to get as aggressive on the rate cuts. Most people have jobs. The unemployment rate is still fairly low. It's below 5%. And so that's all bodes well for these retailers. The Gap is also international, so it's got, big business outside the U.S. as well. But I'm still liking some of the brands that are big in other countries like Old Navy, and that's at a good price point. With inflationary pressures, people are looking to cut costs, and in retail with apparel, they will look to maybe, move down the chain from, say, the Gap down to Old Navy. So Old Navy's been performing well. And again, they are on trend with their product. So I'm putting the Gap on this list as one of the stocks that we talked about this year, but we've really talked about them for many, many years on the podcast. But it's interesting to see if this one can continue to stay in the good graces and not be a value trap, right? It's been a value trap many years, but this year, right now, it's not. It's looking pretty good as we head into 2025. So that's just some of the industries and some of the stocks we talked about. I didn't cover energy in this podcast because those earnings are really coming down, and it doesn't look like a good year in 2025 for earnings. It looks more like value traps there than actual values, but maybe we'll be surprised. All of us are seemingly bearish on energy into next year. And usually when everybody's on one side, then other things happen. So if the U.S. economy holds up well, if China can start coming out of its slowdown, if Europe kind of picks up a little bit of a steam, then usually that spurs demand for energy on the oil side and even on nat gas to some extent. So maybe we will see, some higher prices on those commodities. But for now, WTI oil is trading around $70. That's not terrible for any of these energy companies, but there's fears that it could go lower. OPEC Plus is still cutting, and they've extended their temporary production cuts now, but these temporary ones have been going on for 2 years, and they've extended it out a bit, another from 12 months to 18 months, spreading out some of these production changes that they're doing. They are going to add, a couple of the countries are going to add to production, but they've spread that out to try to, not bring down the price of oil any more than they have to. So we'll see. Oil is pretty complicated right here. I'm not a big fan of it going into 2025. I know this is shocking, right? Many of you who've listened to the podcast for years know that I am a big believer in the oil companies. I thought we were in a bull market. I'm not sure that we are. This could just be a pause in the bull that started in November 2020 during COVID when the Pfizer vaccine was announced. That was the low in most of the oil stocks. They've been running ever since. Then we had the Ukraine war, which pushed up both oil and natural gas prices. Those have come back down to earth. And so what will be the catalyst in energy to get that bull running? Well, it has to be demand. It has to be, China picking up, because the U.S. is already doing around 3% GDP. We're not the issue. It's got to be other countries. So I await to see. We will have some podcasts on energy in the start of the new year. Of course we will, because they are still really cheap stocks. And sometimes if you've got a strong stomach, you can stay in a cyclical like that or buy in when it's not quite at the bottom yet. But I still think some of those stocks have further room to fall, even though some of them have come down quite a bit already. So that's not the area I'm looking for value to start the year in 2025. That doesn't mean I won't end up in energy by the end of 2025. But to start it, I'm not looking there. I am looking in some of these areas we've already talked about. So I still like home builders and anything to do with home, including even on the retail side, but some of those stocks have actually run in anticipation of better times ahead. But we really need more home sales to actually get there. And right now we see a build in inventory, but not a lot of change in actual home sales, both existing and new home sales. So once we get that, more people will go out and buy that new couch for their new house. That's what happens. We always buy furniture when we move. But I'm keeping an eye on those retail stocks. Those would be stocks like Ethan Allen, ETD is the ticker there. Williams and Sonoma, ticker WSM. They own West Elm and Pottery Barn, remember. Havertys, they're big in the Southeast. Many of you probably bought furniture from them. HVT, I want to say. There's Miller Knoll. They are luxury side with Design Within Reach. That is MLKN. I own it in the Value Investor portfolio. There's RH. We just recently owned it in the Insider Trader, but it popped on its earnings, which it does see some better times for next year, but even they were like, meh, we're not so sure. So they're just kind of going along, opening up new galleries, and then hoping that the market will turn. And eventually it will. Eventually we will get those higher sales from the millennials buying homes. But right now it's still a little dubious. Did I miss anyone else? Those are the main retail guys. ARHS. ARHS is that one. That's also kind of more luxury home. Yeah, ARHS on that one. Havertys is HVT. Some of these pay very good dividends. They're still having very good cash flows. So if you're interested in those dividends, check out Ethan Allen. They've always paid quite a nice dividend. ETD, again, they had to change their ticker because they had that Ethereum ticker and they couldn't take it anymore. So ETD, they are a Zacks number 4 right now, but that's, again, some of these estimates are starting to come down a bit on the retailers because nobody knows for sure what's going to be happening. This one is yielding Ethan Allen 5.2% right now. Like I said, these are some pretty nice dividends. Williams & Sonoma's always paid one, but the stock was at new highs, so the yield isn't quite as good with that one. It's just 1.2% for Williams & Sonoma. Havertys, they've been around, like I said, I want to say 100 years or something. That's at 5.5% right now. And I want to say they have a share buyback program too. But, some of these companies, they've been through it all, ups and downs in the housing markets. They went through the housing boom, the housing bust, depressions, recessions, great recessions. A lot of these have managed to survive. They're hanging on, waiting for the turn here. So just keep those on your watch list when you're thinking about housing. But we talked about Toll Brothers today, ticker TOL. We talked about United Rentals, URI. We talked about Powell Industries on energy infrastructure side, P as in Paul, O, W as in Wayne, L as in Larry, POWL. And then we did talk about the Gap on the retail side. GAP is their ticker now. And we talked about Mr. Cooper Group also with housing. That's another way to play it on the mortgage side. But we'll see when that picks up. Ticker COOP is the ticker there. So there is a lot going on with value stocks. I will be back in the new year with a bunch of new episodes. And as always, we will lead off with the classic value stocks to buy to start 2025. That's always a fun one. I always run the same screen every year for that first episode. And I take a look back at what happened to the stocks that were in last year's screen. I haven't gone to look because I always kind of want it to be like a surprise to see how well or not those stocks did after we talked about them to start the beginning of the year. But that's all coming up. So be sure to subscribe. You can get us on YouTube as an audio. You can listen over there, but go to Zach's podcast page. Just put in Zach's podcast. You'll find it there. Subscribe. You can get the ETF Spotlight there, plus the Value Investor, and a couple of our other podcasts are also posted there. But otherwise, I know most of you are on Apple. You can get us on Spotify, Amazon Music. We're on SoundCloud with the Market Edge. But you'll get 2 for 1 over there. But be sure to get us somewhere. And I wish all of you a happy new year. It should be an interesting one for value stocks as we go into next year, especially on this little bit of weakness we're having here. It's making some of our favorite companies look a little more attractive, and sell-offs are always healthy for any bull market. And it's definitely healthy for those of us in the value camp because stocks are on sale and we can get in there cheaper, buy good quality companies. I'm trying to bring them to you every week here on the Value Investor Podcast. So be sure to subscribe. Send me your questions. If there's an area you really want me to look at, put it in the comments on YouTube. I'll check there. So go on to the comments for the Value Investor podcast there and leave your questions there for 2025 because I aim to please here on the Value Investor. But we had a pretty good year for value stocks, but all stocks really had a very good year. So the boat was lifted. All boats were lifted, including value. But 2025 is going to look a little more volatile, I feel, and we'll see what happens then. So again, Happy New Year, happy investing, and I'll see you in 2025.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.